If you want to learn how to pay less taxes legally, this is the video for you. In this video, I'm going to go over tips and tricks from my experiences working at large public practice firms, from all the different methods, from tax credits that you've never heard of and deductions, and all the cool ways that you can save money legally. But the first thing we need to do is go over the tax system and how it works. So figuring out how the tax brackets work. Many people get confused with this. They think that, for example, you'll pay a tax percentage on your full amount. That's not how it works. You get taxed on the bracket. So for example, you'll get taxed 14% on the first 58,523, and then 20.5% from anything between $117 to $58,523. So a lot of people are confused about whether they should be making more money. For example, if we look at this third bracket, we can see it goes from 117 to 181. Somebody, asked me, my next bracket, if I get a promotion, I'm gonna be at 120,000, but I don't want to get taxed at 26%. But it doesn't work like that. Okay, you get taxed only on that $3,000 difference at 26%. Everything else will be taxed at the specific bracket. Okay, so it's always in your favor to make more money. Okay, don't think that you'll be at a tax disadvantage for making more money. Let's say for someone that made 115,000 versus someone who made 120,000. Not how it works. And here is a picture of it just so that you can visualize that. So if you were making 158,000, you can see that the first 58,000 gets taxed at 14%. The difference between 117 and 58,000 will get taxed at 20.5%. And then the difference between 158 and 117,000 gets taxed at 26% up to 181,000. So you're going to do 158 minus 117,000 and $45 and tax that at 26%. And you can see your total payable before any credits and expenses come out to be $38,838. So your tax bracket, how it works, don't worry, you're not at a tax disadvantage. Everything gets taxed at the same bracket for the dollar amount that you make. So, if you make 120,000, only 3,000 will be taxed at 26%. Not a whole 120,000 will be taxed at 26%. Now, if you look at how it actually works in total, you have all your different incomes. So you have your income from employment, income from business, income from investment, income from other income goes into this pool as net income for tax purposes. This is your income. You have some deductions that then goes into your net income for tax purposes. Some of the most notable deductions here would be your RRSP deduction. Then as you go down, you have your Division C deductions, and you'll have your taxable income. Okay, so that's how the tax system works. You have your income here, you get to have some deductions, you'll have your taxable income, and then from there you'll have these credits that you can take. Okay. So one of the most important things here is to look at capital versus business income. So capital gain versus business income. And we're going to think about the apple tree. If you have an apple tree, okay, your business is selling apples, right? You're going to collect these apples, they're going to go into this bucket, and you're going to sell the apples by each apple or by the pound, etc. That's your business, right? But the apple tree itself is capital in nature. It's growing the apples, but you're not in the business of selling apple trees. You're in the business of selling apples. So any income from selling apples will be business income. Any expenses related to the apples will be an expense that you can deduct for your business. But what if you actually sold this apple tree? Would that be considered business income or capital? Well, the thing you have to ask yourself is your apple tree, are you in the business of selling apple trees? No. So it's capital in nature. Yeah, you sold it. It was capital. It was there to make you money over time, but you had to sell it for whatever reason. It gets treated as capital. What's very important here is making sure that you don't classify it incorrectly when you're filing your tax return. Maybe you have stocks, okay, and you trade some, but not very frequently. You're keeping them over a long period of time. That would be considered capital gain if you had any income on that, not business income. And the reason why you want to keep it as capital gain is that income only gets taxed at 50%. So you only include 50% of that income to get taxed, all right? Whereas here, 100% of that income gets taxed. So what that means is if you make 100,000, you have to include all 100,000 as income, and then you have your deductions that can bring it down. In capital gain, only 50% of that gain gets included as income, but you don't get to claim any deductions. So making sure that you know what is capital and what is business in nature is very important for your classification. Okay. The second thing you should know is contributing to your RRSP or your first home savings account. Okay, so you get a deduction when you contribute. Now, if you're the highest bracket earner, these tax savings can be plenty. Okay, remember, if you're at the highest tax marginal bracket, you're going to get taxed around 50%. Okay, that's going to include 33% of your federal tax rate plus your provincial amount as well. It works out to be around 50%. Obviously, it depends on which province you're in. So your contribution here, because we're taking it, we're going to get a full deduction. It's going to bring down our net income for tax purposes. You're going to get taxed. You're saving that 50% tax rate that you would otherwise have to pay tax on. So $5,000 contribution saves you $2,500. 30,000 contribution to your RSP saves you 15,000. Okay, so these are huge savings for you. Okay, huge tax savings that you should consider. And if you are a high bracket earner, you should contribute to your RSP or your first home savings account. Remember, your first home savings account, you still get a deduction on your tax return, but you can withdraw it for you to purchase your first home. Okay, so if you're going to purchase your first home, you haven't had a home, you're planning in the future, you should put it into your first home savings account, get the deduction, then withdraw it and pay it back over that 15-year period. Okay, so you're gonna have to pay it back eventually, but it's very good for you for your planning, for your tax planning purposes for the future if you purchase your first home. Okay, because you also get this massive tax saving. Now, what a lot of people don't know is you also have this thing called your first home buyer's tax credit. Okay, it says who can claim the credit. Generally, you can claim the home buyer's amount if you meet all of the following conditions. You or your spouse acquire a qualifying home and you did not live in another home inside or outside of Canada that you owned in the year of acquisition. Okay, and how much can you claim? So in this credit, you can claim $10,000. Okay, so just by being able to qualify for this credit, you get to have a tax credit of $10,000, which of course is a tax reduction of $1,500. That's like receiving $1,500 in cash, because you have to multiply that by this 15%. All these credits get multiplied by 15%, and that's the amount that you'll actually get back as cash. So if you have a first home that you're purchasing, or you're planning to purchase it in the future, or you already have, this first home savings account can give you these massive tax savings when you contribute, as well as you get an additional credit when you file your tax return. You're just going to need to include this $10,000. Remember, this credit came out earlier. So if you had a home that you purchased earlier in a prior year or any of the previous years, you can go back, amend your return, and include this credit. This credit has changed over time. At one point it was $5,000, now it's $10,000. So just make sure that, it depends exactly on the year. Okay, so make sure what year you had it and make sure you go in and you look at this credit. So this is actually one that is commonly missed. A lot of people don't know about this home buyer's tax credit that you receive if you qualify for purchasing your first home. This is something that this Canadian government actually, they want to help you with purchasing your first home. Okay. The next thing is pension splitting. Again, a lot of people don't know that you can split pension with your spouse. Okay, so these are for people that are in their pension, they've retired, you're above 65 years old of age and you're receiving pension income. You can split up to 50% of your pension to your spouse or common law. And this 50% or this allocation that you have does not have to be the same percentage year over year. What you do need to file is this form T1032. A lot of this does have, this is more complex, this pension splitting. There are rules to it, but it is something for you to consider when you are filing your tax return. Let's say you're filing with Wealthsimple Tax. Again, if you are filing your own tax return, I do recommend using Wealthsimple Tax. That is the tax software that I use when I file my tax return. If you do fund your account, you'll get $25. Click the link in the description. And if you are using the tax software, they will generally have an option that says, do you want to split your pension income? And you'll just say yes, because it'll be better for you, okay? And they'll split it in the best possible way, up to that 50%. You can see the what you can actually elect, what is important, what are the requirements here. Again, what's most important for you is making sure that you qualify for this, and that when you are filing your tax return, or you have an accountant that's doing your tax return, you tell them that you want to make sure that they split the income in the best possible way to be the most tax friendly, for you to save the most money on tax. So you have this option. Most of the time on the software, it's just a click of a button and it does it for you. So pension splitting, very important. That is something that's also commonly missed. Self-employed, okay. So these are for the people that, you're highly skilled, and perhaps you could work as a contractor somewhere. It may be better for you to work as a self-employed person than an employee. Why? Because you can claim business expenses. So this is all else equal. Let's say you're a highly skilled worker. You don't have to work as an employee somewhere. You could just as well work as a contractor and make self-employed income, business income. There's a list. These are just a list of a few things you can reduce and deduct for your tax purposes. So here, a bunch of different things that you can deduct as a self-employed person versus an employee. You get very few amounts that you can deduct as an employee. So it's always better to be self-employed for tax purposes, because in this example here, you have $30,000 that was deductible that otherwise would not be deductible if you were just an employee. And there are stringent rules here. Most of the time, when you're having your own business, the CRA, they allow you to deduct things that are related to your business. When you're an employee, very difficult to get the deduction, and very few things are allowed. So if you have the skill to be a contractor, it may be in your best interest for tax purposes to work as a contractor than an employee. Your RESP contributions. So if you actually have any children and you want to pay into their future, have a fund, they want to go to university later, you can receive grants. So this is the Canadian government giving you free, essentially, money for their future. Okay, so it's money putting aside for them. There are two types. You have the CLB that provides a $2,000 maximum that's eligible per child. And again, it's only for families living with low income. And then you have the CESG that provides up to $7,200 maximum per eligible child. So here you can see with the CLB, you get $500 on the first year and then $100 after each year until they're the age of 15. On the CESG, it depends on how much you're contributing. So it does go up as you make contributions to it. They'll do 20% of your contribution, at least up to $500 for the first year. And then again, this doesn't have an income, all incomes for low or middle class incomes can get this grant from the Canadian government, okay? And then the final thing that most people don't really know much about is your medical, tuition, and your donations, okay? So if you are, if you have large medical expenses, you can claim that potentially depending on the amount of income you make and the amount of medical expense and the nature of it. Your donation as well, if you're donating to actual registered charities, you can get a slip from them and claim these donations, as well as your tuition credit. If you're going to school and you get a slip from your university, you can also claim this as a credit. And again, I've done videos about these ones in detail, so make sure to check out my channel, okay? So these were a couple things that we just looked at to save you money in the future legally. And if we look at it, There's just a bunch of different things here that you can take, whether it is just, pension splitting, your home buyer's tax credit, contributing to your RRSP, treating things capital versus business income if possible, being self-employed. These are all things that can save you money in the future when filing your taxes. And if this video helped you, make sure to subscribe for more practical Canadian tax guidance videos. If you haven't, already, take a look at my previous videos on the medical credit, the donation credit, the tuition credit. Remember, this is just general information, not personalized advice.